What we're going to be going over here is a bank reconciliation schedule. We're going to be going over the overview of the schedule, what's included on it, and how it's used. And we're going to be looking at it in terms of a company that receives a bank statement from their bank each month. So what is this bank reconciliation schedule? Well, it's a schedule explaining the difference between the bank's and the company's records of cash. If differences results only from transactions not yet recorded by the bank, the company's records of cash is considered correct. But if some or part of the differences arise from other items, either the bank or the company must adjust the records. So we're going to be looking at a form shown below here which reconciles both the bank balance and the book balance of cash and consists of two sections that we'll look at here. So here's this bank reconciliation schedule. So we're going to have a balance per the bank statement, and that's at the end of the month that the company would receive here from their bank. And what it would have here is some cash balance, beginning cash balance. We have to make some additions or subtractions to the bank statement here, this balance here, to determine the correct cash balance. And then we're going to have the balance per the depositor's books. This is the company's books, what's sitting on the company's books here for their cash balance. And again, same period, the end of the month here. And there's going to be some cash balance here, and we're going to have to make some additions and subtractions to the book depositor's books amount here for cash to determine again the correct cash balance here. But before we get into these additions and subtractions that we have to make to these to our cash balances here, let's go and first look at the definition of what these items might be here. So the deposits in transit, those are the end of the month deposits of cash on the depositor's books, the company's books, which are in 1 month here. Let's say the current month here that we're looking at, but they're received by the bank in the following month. So they aren't included in the current month that we'd be reconciling here, but they'd be coming in the following month to the bank. Now, outstanding checks. Those are written by the depositor, the company here, but do not clear the bank until, again, the next month here. So they aren't included on this current statement here, but they're going to clear the bank in the next month. And then bank credits. Those are collections or deposits here for the benefit of the depositor here. They are on the bank statement, but they aren't recorded on the books of the company's books as of yet. Now we have bank charges here. Those are also listed on the bank statement. Those are charges against the depositor, such as non-sufficient fund checks, printing of checks, bank service, and it can go on to any number of items here. Those would be on the bank statement here, but not yet recorded on the company's books here. And then we have bank or deposit errors. Those are errors either by the bank or the depositor which cause the bank balance to disagree with the depositor's book balance. So here the bank balance doesn't agree with the depositor's books balance due to errors either by the bank or by the depositor or the company here. So let's go back and look at this bank reconciliation schedule. So here we have the balance per the bank statement here, and we have a given amount here. But before we get into this, let's just go up and look at where we'd get some of this information. So here's where we'd get this information. It would be sitting here per the bank. There's going to be balances, deposits is recorded, checks recorded, and so forth, and all other kinds of charges. And then we're going to have per the books what's recorded here on the company's books for those same deposits, checks, and so forth here. So let's go back down and look at our bank reconciliation schedule here. So the balance per the bank statement here, we start with this beginning balance, but we have to make these adjustments to it, and I've got them listed here, plus and minuses here. So first, plus, we'd have to add in deposits in transit. We'd have to add that to the beginning balance. Then we'd also have to add undeposited receipts. That would be the cash on hand that the company has in the cash on hand. That would have to be added. And then we'd have to add any bank errors that understate the bank balance. Any bank errors that understate this bank balance, they'd have to be added. Then we'd be subtracting out any outstanding checks. Those would have to be subtracted out from that beginning balance here. And then we'd also have to subtract out any bank errors which overstate the bank balance here. Those would have to be subtracted out. And taking all our pluses and minuses here, we'd have to subtract or add them here from our beginning balance here. In this case, it was $17,300. And then we would have, I got 0 showing here, but nonetheless there could be any number of values in here. And then we would add and subtract them here to come up with our correct cash balance here. So that would be the correct cash balance after all our additions and subtractions here. Now looking at our balance here per the depositor's books, or the company's books here. Again, the same period, and we begin with some cash balance here. So what we'd have to do, we have to make the same additions and subtractions here. And first we'd have to add bank credits and collections not on the books here. Any bank credits or collections that the bank made here that wouldn't be recorded on the company's books would have to be added. Then we'd have to add back book errors which understate the book balance here. Those would have to be added back here. And then we'd have to subtract out bank charges not on the books. There may be any number of bank charges that are on that bank statement, but they aren't on the books. Those would have to be subtracted out here. And then we'd have to subtract any book errors which overstate the book balance here. So if we got any book errors which overstate this book balance, those would have to be subtracted out here. And with all our additions and subtractions here from our beginning balance here to depositor's books, we'd come up with the correct cash balance here. So what we have to do is we have to match, they have to agree here. The correct cash balance here per the depositor's books has to agree here with the correct cash balance here per the bank statement here. So then we know that we've got our additions and our subtractions are property when they both agree here, and we come up with the real cash balance that we have here. So now, one other item we have to talk about here. Now, the companies prepare adjusting journal entries for all the addition and deduction items appearing in the balance per the depositor's books section. So, per the depositor's books, any items here that we would have had to include either as a adding back or subtracting from, they have to be included here. They have to be, the books have to be adjusted to match these pluses and minuses, or the additions and subtractions that we made here. Now again, remember here, this bank reconciliation schedule, you go through that each month here, and these items that we went over here, they have to be included in, if there is any item, it has to be included either as a plus or minus here from whatever the beginning balance is. So this is an overview of a bank reconciliation schedule and how you would set it up here and then how you would use it here. So all right, this is it.